Gold to $15,000 by 2027. Here's why. This weekly finish matters. Everyone is talking about the number $15,000, but nobody is asking the right question. It's not whether gold gets there, it's what happens to you if it does, and you're not positioned. Because the weekly finish we just witnessed wasn't a headline, it was a warning. And the last time the market sent this exact signal, what followed changed everything. Welcome to the Comics Chronicles. Now, before we go any further, think of this channel like your most trusted, sharpest friend, the one who always told you the truth before everyone else figured it out. You know that person? The one you wished you had listened to sooner? That's us. So do what you should have done with that friend. Hit subscribe right now. Don't wait. Because unlike that friend, we'll still be here. And one more thing, drop it in the comments. Where in the world are you watching from today? Because this story travels further than most people think. Every Friday evening when the markets close, a small group of people sit quietly at their desks. They are not watching the news. They are not reading social media. They are watching one single number, the weekly finish. And on a recent Friday evening, that number did something that stopped them cold. Gold closed the week above a level that just 3 years ago sounded like a fantasy. Not a spike, not a rumor. Not a Monday morning headline that disappears by Tuesday. A full weekly finish, confirmed, locked in. And the moment it happened, the conversations started. Not in the newspapers, not on television. In the quiet rooms where serious money makes serious decisions. Now here is what most people get wrong about a weekly finish. They think it is just a number at the end of a week. They treat it the same way they treat a daily close or an intraday high. But it is not the same. Not even close. Think of it this way. Imagine a jury that has been arguing for 5 days straight, Monday through Friday, back and forth. Disagreement after disagreement. And then on Friday evening, they finally reach a verdict. That verdict is the weekly finish. It is not emotion. It is not a reaction to one piece of news. It is the market's final answer after 5 full days of argument. And when that answer comes in above a major level, it means the market is not just visiting that price. It is living there. For the casual investor watching from the outside, this looks like any other week. Gold went up. Gold is at a high. Nothing unusual. But for the investor who understands structure, the weekly finish tells a completely different story. It tells them that institutional money, the kind that moves slowly, deliberately, and in enormous size, has decided to stay. Not to test the level, not to touch it and leave, to stay. And that distinction is worth everything. Here is where the story gets deeper. Gold has not just posted one strong weekly finish, it has been posting them with unusual consistency, week after week, record after record. And this is the part that the viral posts and the social media charts are missing entirely. It is not just the number that matters, it is the pattern behind the number. Because when weekly finishes cluster together, when records begin to pile on top of each other, it signals that something fundamental has shifted in the market. Not a mood, not a trend, a shift. The kind of shift that separates a regular bull market from something far more rare, far more serious, and far more dangerous to ignore. But here's the warning that almost nobody is giving right now. A cluster of strong weekly finishes does not tell an investor where they are in the story. It could be the beginning of something massive. It could be the middle chapter, where confidence is building but the real move is still ahead. Or it could be the final pages, where everything looks strongest right before it turns. The weekly finish tells them that something is happening. It does not tell them when it ends. And confusing those two things has been the most expensive mistake in the history of gold investing. This is the central truth that the $15,000 conversation is built on. And this is the truth that the serious investor must understand before touching a single position. The weekly finish is not magic. It is not a prophecy. It is a confirmation. A confirmation that demand is real, that commitment is real, that the market has spoken, at least for now. What comes next depends on 5 forces that most analysts are not explaining clearly. And that is exactly where this story goes next. The number $15,000 did not appear from thin air. It came from a calculation, a historical multiplier, a pattern borrowed from the past and applied to the present. And that is precisely where the danger begins. Here's how the calculation works. In the final stretch of the last great gold bull market, the one that defined the 1970s, gold did not move gradually. It accelerated. In roughly a year and a half, it multiplied by more than 3 times. So when analysts look at today's gold price and apply that same multiplier, the math lands somewhere near $15,000. Clean, simple, compelling, and dangerously incomplete. Because a multiplier is only as useful as the conditions that created it. And the conditions of the 1970s were not accidental. They were the result of a very specific combination of forces arriving at exactly the same moment. Inflation was not just rising, it was psychologically embedded. Ordinary people believed prices would keep climbing, and they changed their behavior because of that belief. Oil shocks were disrupting the global economy in ways that had never been seen before, and the monetary system itself was still finding its footing after the end of the Bretton Woods Agreement, the moment when the dollar was finally cut loose from gold entirely. That cocktail produced that multiplier, and today's world is mixing a very different cocktail. So what are the 5 forces that would need to align for gold to reach $15,000 in this cycle? The first force is real yields. Over long periods of time, gold has tended to move inversely with inflation-adjusted interest rates. When real yields fall, when the return on holding a bond after inflation becomes unattractive, capital begins searching for alternatives, and gold becomes one of the most obvious destinations. Right now, the debate around real yields is not settled, and that unsettled debate is one of the reasons gold has remained volatile even as it climbs. The second force is dollar confidence. Gold is priced in dollars. When the dollar strengthens sharply, gold typically faces a headwind. When the dollar weakens, gold tends to benefit. But here is what the simple chart does not show. A currency can look strong on paper and still be losing confidence in the real world. And it is confidence, not the index number, that ultimately drives where global capital flows. The third force is inflation expectations, not current inflation. Expected inflation. If the market believes that purchasing power will continue eroding faster than governments will admit, gold becomes not just an investment, it becomes a necessity. That shift in psychology, from optional to necessary, is what creates the kind of demand that pushes prices into historic territory. The fourth force is official sector buying. Central banks, reserve managers, sovereign wealth funds. These are not buyers who check the price every morning and react to headlines. They are institutions that think in decades. And according to the most recent publicly available demand data, they have continued buying even as gold reached repeated record levels. That is not panic buying. That is strategic repositioning. And when institutions of that size decide to reposition, the floor under a market changes permanently. The fifth force, and the one almost never discussed in the $15,000 conversation, is positioning. Who is already in this trade? Because a market full of late arrivals chasing momentum is a very different market than one being quietly accumulated by patient capital. When leverage enters a crowded trade, records can pile up fast. But when that leverage unwinds, the drop can be swift, brutal, and deeply misleading. It can look like the end of the bull, when in reality, it is only the shakeout before the next chapter. And that next chapter involves 3 forces that almost no analyst is discussing openly. 3 forces that are quietly building the foundation beneath this market that most investors will not understand until it is too late to act. Deep underground, somewhere beneath the surface of South Africa, A machine is drilling. It has been drilling for 3 years. The permits took 2 years before that. The financing took 1 year before that. And after all of that time, after all of that money, after all of that effort, it will produce enough gold to supply the global market for approximately 4 minutes. 4 minutes. That single image tells the entire story of gold supply. And it is the story that the $15,000 conversation almost never begins with. Most analysts start with demand. They talk about buyers, about central banks, about investors flooding in, and demand matters enormously. But supply is the silent force underneath everything, the force that determines whether demand can actually move price or whether new production simply absorbs it. And in gold's case, supply cannot be turned on like a tap. A new gold mine does not open because price rises on a Friday afternoon. It opens after years of geological surveys, years of environmental permitting, years of capital raising, years of construction. And even after all of that, the mine must operate profitably because energy costs money, labor costs money, equipment costs money, refining costs money, and those costs do not fall simply because gold's price is rising. In fact, in many cases, they rise together, which means the profit margin for new production is far thinner than the headline gold price suggests. This is why the supply response to rising gold prices is always slower, always smaller, and always more complicated than the optimists assume. And then there is recycling. When gold prices rise, some investors sell their old jewelry, their coins, their inherited pieces. This recycled gold enters the market and provides a degree of additional supply. But here's what the models miss. Recycling is deeply psychological. People recycle when they believe the move is finished, when they believe they are selling near the top. But when they believe the move has further to go, they hold, they wait, they watch. And in a market where the majority believes gold is heading significantly higher, recycling flows slow down precisely when analysts expect them to accelerate. Supply stays tight, demand stays strong, and price has only one direction available to it. The second force that most analysts are ignoring is the true nature of central bank buying. When a central bank buys gold, it is not making a trade. It is making a declaration that says, we no longer trust the current system to protect our reserves at its current level. That is an extraordinary statement. And central banks around the world have been making it quietly, consistently, and at scale. According to the most recent publicly available demand summaries, official sector buying has remained durable even as prices reached levels that once seemed unreachable. These institutions are not buying because they expect to sell at $15,000. They are buying because they are repositioning their entire reserve structure for a world that looks different from the one that existed 20 years ago. When the largest and most conservative financial institutions on Earth begin restructuring away from traditional reserve assets, that is not a trend, that is a transformation. And that transformation leads directly to the third force, the quiet collapse of the bond as the world's unquestioned safe asset. For decades, when serious money needed safety, it went to bonds, government bonds, treasury bonds, the instruments backed by the full faith and credit of the most powerful economies on Earth. But something changed, slowly at first, then with increasing speed. As government debt levels reached historic highs, as fiscal spending expanded beyond what many economists considered sustainable, as inflation eroded the real return of holding fixed income instruments, the bond began to lose something it had held for generations: trust. And when trust leaves a safe asset, capital does not sit still. It moves, it searches. And increasingly, it is finding its destination in the same place it found safety thousands of years before modern finance existed. These three forces, supply constraints, strategic central bank repositioning, and the erosion of bond credibility, are not temporary headlines. They are structural realities, and they are building something beneath this gold market that most investors will not see clearly, until the weekly finish tells them it is already too late to ignore. There is a particular kind of investor who does everything right. They read the research, they study the history, they understand the supply constraints, they watch the central bank data, they see the weekly finishes climbing higher week after week. They understand the thesis completely. And then they lose money anyway, not because they were wrong about gold, but because they were wrong about themselves. This is the part of the $15,000 conversation that nobody wants to have, because it is not about charts. It is not about multipliers. It is not about historical comparisons or supply mechanics or central bank declarations. It is about the single most unpredictable variable in any investment decision: the investor sitting in the chair. Here is what a big headline number does to the human mind. It creates an anchor. The moment an investor hears $15,000, that number takes root. It becomes a destination, a certainty, a promise the market has not actually made. And from that moment forward, every piece of information gets filtered through that anchor. Good news confirms it. Bad news gets dismissed as temporary noise. A sharp pullback that should trigger a rational reassessment instead triggers denial. Because the anchor says $15,000, and the anchor feels more real than the red numbers on the screen. This psychological trap has destroyed more sound investment theses than bad research ever could. Because the thesis was correct, the position was correct, the direction was correct, but the investor could not survive the journey to get there. And the journey will test every serious investor in this market, because this is not a calm, orderly bull market. It is a volatile, two-sided, emotionally brutal market that produces record highs and gut-wrenching drops, sometimes within the same week. That volatility is not a malfunction. It is the admission price. The market is not going to allow serious wealth to be built without serious discomfort along the way. It never has. It never will. So the investor who says they want the $15,000 destination, but cannot tolerate a $500 weekly drop, is not actually prepared for this journey. They are prepared for the version of this journey that exists only in their imagination. So what does a serious decision framework actually look like? It begins with one foundational question. What is gold in your world? Is it a trade? A short to medium term position designed to capture a specific move and then exit? Is it a hedge? Protection against a macro scenario that would damage the rest of the portfolio? Or is it a core holding, a long-term allocation that reflects a fundamental view about monetary credibility and store of value? Each answer demands a completely different approach. The trader must define entry, exit, and maximum acceptable loss before touching the position. The long-term holder must be honest about whether they can genuinely hold through a 30 or 40% drawdown without panic selling at exactly the wrong moment. Because in late-stage bull markets, that moment always comes. The market manufactures it deliberately. It creates a breakdown so convincing, so technically clean, so supported by frightening headlines, that even experienced investors question everything they believed. And then, after the weak hands have sold, it recovers. And the weekly finish tells the story again. Here's the checklist that separates serious investors from narrative followers. First, define what would confirm the thesis. Strong weekly finishes holding above key levels, official demand remaining durable, real yields staying suppressed, dollar confidence continuing to erode. These are the conditions that keep the thesis alive. Second, define what would invalidate the thesis. Weekly finishes that repeatedly fail near highs. Official demand visibly cooling while speculative leverage looks stretched. Real yields rising sharply while gold loses ground and cannot recover. These are the signals that demand a reassessment, not denial. Third, decide in advance what the response will be to both scenarios. Not in the moment, not when adrenaline is running and headlines are screaming. In advance, in writing, with a clear head. Because the investor who decides their response during the crisis is already too late. The final phase of a gold bull market is where the biggest gains are made. History is clear on that, but history is equally clear on something else. The final phase is also where the most capital is permanently destroyed, because the final phase attracts a specific type of participant, the gambler, the person who arrives late, sizes the position recklessly, ignores risk management entirely, and bets everything on the headline number becoming real. And sometimes the gambler wins for a while. But when the reversal comes, and in every cycle it has come, the gambler does not have a framework. They have a hope, and hope is not a strategy. So as this market continues printing weekly finishes that the world is watching, the serious investor is not asking whether $15,000 is possible. They already know the conditions that could make it possible. They already understand the forces building beneath this market. They already see the signal in the weekly finish. What they are asking is a far more powerful question. Am I positioned to survive the journey and remain rational while everyone else loses their mind? Because that is the entire game. And the answer to that question will determine everything